We're live
We are
already.
live.
Welcome to Coffee with Your Coach and Consultant. All this month, we have been talking about exit, planning an exit for your business. What's that strategy? And we've got a few fundamental things that we want people to know about being in business, knowing that you, even if you don't think you could ever sell your business, should start thinking about an exit strategy. And what makes it easier for us to work with you to make your business more valuable and more sellable.
And there are a couple of mindset things associated with that. We could start off by saying that going into a business with the idea that at some point it's not going to be your business, you're going to exit the business. And the term always ready to sell arts. So you always want to be ready to sell your business for a couple of different reasons. One is that you will at some point. The thing there, of course, is it could be voluntary, it could be involuntary. So there are things that happen in life that cause you to involuntarily exit your business. And CRA, because tax planning forms a large part of these kinds of conversations, doesn't really care why you're leaving your business. The tax treatment is basically the same. So always ready to sell.
So no matter what stage in your business, there are a few things that we say will make it easier to get ready. One of those things, of course, is the mindset piece of thinking about it and being open to that possibility. And when you are open to that possibility, when should you really start planning that exit?
We do a lot of long-term planning for clients, and an excellent window is 15 years. It doesn't get better than that. So if you're let's call it 40 to 50-year-old business owner, as young as in your 30s, we have, sort of a 15-year window. There is a lot that can be done to optimize the value of your business, to get your wealth strategy in place, to generate the highest possible tax efficiency on your expected exit with a 15-year window. We've done lots of work for clients that have a 10-year window. There's still lots that can be done there. Structurally, so a lot of tax efficiency comes from the way your corporations are organized. There's a 2-year window that is very, very important from a tax planning perspective. And so if you're 2 years from exit, there are some things that can be done to actually capture some of the efficiency that you might not otherwise have available to you. But it's also the case that sometimes we find clients and clients find us when they're imminently exiting their business.
And trying to figure out how do they get the most out of it. And often they will feel like they're just trying to fix a mistake, or they've screwed up, they've left it too late, and they're just hoping that we can patch together financial ideas and magic trickery that will help them make the most out of their exit. So this past month, we've had somebody come in, very small business. They've been kind of scaling down over time, definitely losing some of the value of the business, now down to just 2 of them in the service business, looking at an opportunity to exit with the most possible in, say, the next couple of months, which is a bit of a flabbergasting dilemma for everyone and for any financial planner thinking about what that is. It's challenging. So one of the first places that we start is who is going to buy your business, because who you can sell it to gives us a bunch of options that we can look at. And it isn't some big corporate sterile environment when you're selling your small business to probably another small business and being able to capture value and get them some real value too. That's actually where these people came in and we started that conversation.
And essential to that conversation or to the value that you can experience on exit is that as you were working on your business, you created an asset that is separate from yourself. That's an essential thing, of course. So if all of the business's revenue, so if you're a consultant, for example, and all the value that the clients get from working with you is your own knowledge and your own information, then there's nothing really you can sell, because you would have to sell yourself with the business, and that's a little bit of a challenge. Once you've created something separate from yourself, and it is the case with this particularly small business, that they have also built an asset. So the asset that they have built that is separate from them is the basis of the possibility of selling their business and creating some wealth as a result of all of the work over all the years, in addition to the income that they pulled. The sort of third piece of this is usually when you create a business that is separate from you, so there's a value that is separate from you, you probably didn't need all of the cash flow that the business was producing while you were running it. So you took whatever you needed to take out, salary or dividends, to have the life that you wanted to live, but you probably left some money in the business. So if you arrive at the exit point and there's a saleable business because there's something separate from yourself that somebody would want to buy, and especially if you have, they're called retained earnings. So you didn't take all the money out of the business, retained earnings. There are very much some planning opportunities that can actually save you quite a lot of tax, and sort of even in the 11th hour, create a very different wealth plan than the one you might have expected.
And one of the other key things that this client has, they pay themselves salary instead of dividends for the life of their business, which is actually a very important thing. And there's a lot of misinformation about salary versus dividends and which is better. And from a place of flexibility, you're paying yourself a salary for the work that you're doing in the business. Dividends, in addition, as a separate conversation, that was one of the key things they've done really well, really smart. So when they came in, that the knowledge in their business that they could sell, the goodwill that they built up in their business they could sell, the retained earnings that could be used in planning, as well as the fact that they had a corporation and they had paid themselves a salary, were all those pieces to put together for a perfect storm to say, now, is there a buyer who will buy in the way that you want to sell? And they actually were having those conversations, very collegial people. They know their co-opetition instead of just being all about the competition, relationships with other people in the industry. So they actually had someone in mind to start designing their exit around.
Yeah, I'd like that's an excellent point, Cher. The taking salary, and we have these conversations all the time with clients and their accountants. Boy, taking salary is an important pillar of your long-term wealth planning. I cannot emphasize that enough. And lots of people, oh, dividends, lower tax rate. That's not true. And there's some math involved there that you need to understand. But boy, it is an important part of your planning. And for these particular folks, having taken salary for the many, many years that they ran their business, actually enabled this exit late stage wealth planning that otherwise would have been unavailable to them.
And it's very exciting when we meet small businesses and we can say, yes, we can help you. Because the difference in yearly income for the rest of their lives that we're able to put in place is six figures. Because it was not a six-figure retirement they were looking at. It was a tough retirement they were looking at. And so at the end of this, we do this wonderful, my favorite session is that presentation of the financial plan, whether it's where your business is going to grow to profitably or where your life is going to go to. We've got a couple of really exciting sessions where we share, business owner, this is your business. And they go, oh my goodness, I can't believe now that the profit margins are fixed, what it's going to produce over the life of the business. This other presentation, which is business owner, this is your retirement and your legacy. And it builds us up, it fills our hearts. And for this particular pair of business owners, sitting with them and letting them see what is taking the next couple of months to plan and be prepared instead of seeing what happens, which is a temptation, right? People get, they're sure that nothing's going to work. So they go, yeah, well, we'll see what happens. They're being proactive and planning. And at the end, one of the partners said, pretty sure this is where we applaud. Tears in all of our eyes to be able to have this impact on a small business, because you are the lifeblood of our community. You are our employers. You're driving our local economy. And to get to the end of your business and not have it pay off in the end is heartbreaking. And it doesn't have to happen. There are some things that really make a difference if you put them in place. And thank goodness these gentlemen had done so, because what they get to experience is a very comfortable rest of their life.
So I think in a nutshell, sooner's better.
Yeah.
Absolutely, always in almost everything, sooner's better. But there is a right time in everybody's business life and personal life where it is time to go get some expert advice on how to make the most of all of the life's work that you put into your business. And almost always it's not too late, so that an impactful thing can happen related to the business itself, the sale of the business, or the wealth that is generated from the sale of the business.
So if somebody has suggested to you that you should do a corporate restructuring, perhaps your accountant, there's a right way and a wrong way to do that. Please talk to us, but that's an interesting sign that your business is big enough. You should actually be doing exit planning. If you are thinking about a reorg and you have no exit plan and no complex financial plan, then you are putting in place something that you don't know how to use. That is a good sign that you should be exit planning. If you have retained earnings where you go, should I just draw these from the business? Also a good sign. It is time to exit plan, not necessarily exit. If there are ways that you're trying to step out of the day-to-day operations of your business, you're actually creating an asset already, and you may not even realize it. There's some really good signs of when should I start respecting my business and my retirement enough that I design how it's going to pay off now and at exit. And so one of the ways that you can discover some of these things and look into your business is to come to our workshop, May 16th. We have a VIP day that is almost a full day of just diving into how do you make your business more valuable and more saleable. It is called Built to Sell. We're holding it right here at Office Inc. in Barrie, Ontario. It's a live in-person event, so you can ask your questions, get the answers to some of the questions that you might have been hesitating to ask yet. We'd love to host you here. You will see the link to the Built to Sell VIP Day in the description of this video. Once it has finished processing, I'll go edit that and add the link.
Excellent. Yeah, we look forward to these sessions. It will cover all kinds of different aspects of having a business that's always ready to sell, that are amazing. Things that generally people aren't thinking about, and they're important. So we're looking forward to seeing you there.
So I guess that's it for today.
Yeah.
You'll see a couple more videos going out about our exit series. And if you have any questions, always reach out and ask. We hope to see you in person, but my goodness, that's still a month away. So feel free to comment or reach out to us and we'll answer your questions today.
I'm Jim Pillow. I'm the consultant.
And I'm Cher Cunningham. I'm your coach. We'll see you next time.